Hello. In this video, we'll be going through long-term contract accounting part 3. When a company has a long-term contract where they require many years or over a period of more than 1 year, such as building, a hotel, or part of a freeway, that the contract can be over a long period of time, there are two ways that the company can recognize revenue. It could be at the end of the contract, but usually that's not what happens. It's under a method called percentage of completion. And in that situation, the company recognizes revenue based on the cost that they've incurred up to that point. This is the part 3 of a series of videos about long-term contract accounting, and I'm going to dive in and go through another example. So if you haven't watched part 1 and 2, I encourage you to do so. As I go through this video talking about contract losses, I'm assuming that you are familiar with part 1 and 2. So we have been working with this example in the several videos where a company has been hired to build a building for $500,000 and over a 3-year period. So we have a contract price of $500,000. We have the costs that are incurred during the year, estimated cost to complete the whole project year over year, billings to customers in current year, and cash receipts from those customers. I'm going to delete these last 2 items because those only affect the balance sheet journal entries, and we're focusing more on the income portion of the financials. So if you're not familiar with those entries, you can go back and look. That's video 1 where we discuss the balance sheet. Okay, so year 1 right here where we have the costs incurred during the year is $150,000 and $225,000 is the estimated cost to complete. That is no different than what we've seen in the prior videos. For this video, we have some different facts starting in year 2, where the cost incurred during the year in year 2 is $126,000, and the estimated cost to complete is $184,000. And then year 3, the total cost incurred during the year is $184,000. So let's move over to the right over here, where in year 1, under the percentage of completion, year 1, we incurred 40% of the cost that we anticipate, and so therefore we recognize 40% of the revenue, and the cost to date, the cost during the current year is $150,000, so we recognize $50,000 of gross profit in 20X1. Now let's go to 20X2. Contract is $500,000. Our cost to date now is $276,000. Let's go back to our facts, and that is made up of year 1 estimate. Year 1 cost incurred is $150,000. Year 2 is $126,000. So our total costs incurred to date as of 12/31 20X2 is $276,000, and we're told that the estimated cost to complete is $184,000, bringing our total to $460,000, which under the percentage of completion, we take our cost to date divided by our estimated total cost, and that'll give us the percent that we should be recognizing revenue to date. So the 60%, this is all basically a review. I'm going to take my revenues and $500,000 times 60%. Oops, that should say 60. And the formula is right though. The total cost that we've incurred to date is $276,000, showing us a gross profit of $24,000 to date, which means that between 20X1 and 20X2, we should be recognizing $24,000 of gross profit. However, in year 1, we recognize $50,000 of gross profit. So we really need to reduce our gross profit. And the way we do that is we're going to actually show a loss for the current year. We're going to record our revenues for $100,000, which is going to be the $300,000 of revenue that we're supposed to be recognized to date, less the prior years we've recognized $200,000. So in the current year, in 20X2, we will recognize $100,000 of revenues. And now we have to actually recognize more revenue, more costs than revenues, because we need to have an overall gross profit of 24, and we've already recognized 50. So we're going to record this $26,000 loss. And the way we do that is we're going to credit revenue from long-term contracts for the $100,000. We're going to debit cost of construction for $126,000. And then the plug is going to be a credit to the construction in progress account. Now, let's go through to then 2003. Our cost to date is $460,000, and it's the end of our contract. So our contract price is $500,000. Our total cost is $460,000. So our actual gross profit is $40,000. And we're going to go through the same process as we did before. Again, if you're not familiar with it, please go back and look at the previous videos. And we're going to record gross profit of $16,000 for the current year. And we're going to go back to our entries right here, and we're going to credit the rest of our revenue, but for $200,000, debit cost of construction for $184,000, and debit construction in progress for the plug of $16,000. So why am I going over this in a separate video? This is called a periodic loss, where over the term of a long-term contract, the expected profit, gross profit for the contract each year is still expected to be profitable. However, in this situation, we had 1 year where we actually, in year 20X2, where we had to record a gross loss, not a gross profit. Okay, and so you go ahead and you just do that during the year that it occurs, because overall the project is still estimated to be profitable. If at some point the entire project is estimated to be a loss, then your accounting changes, and that's going to be in the fourth video that I'm going to go through that. But let's just go to our T accounts that we've been looking through. Our billings on construction contract does not change. Now, our construction in progress for our 20X1, X2, and X3 construction costs, that comes from the balance sheet side of things. And as you recall, our 20X2 amount did change. That's why we had this periodic loss in year 2. But the entries of how to record them are the same. So I've laid out the T accounts here, and you can see that at the end of 12/31/20X3, the construction in progress has a $500,000 balance, and the billings on construction contract has a $500,000 credit balance. And so we need to close those out by debiting billings on construction contract and crediting construction in progress. And that will be right here. That's our very last entry that we do upon completion of the contract. Again, the way we present our balance sheet is also not different. We present under current assets our accounts receivable. And if our construction in progress, you net the balances between the construction in progress and the billings on construction contract. And if the CIP is larger than the billings, then you have a current asset for that amount. And if your billings is larger than your CIP, then you're going to have a current liability, and you record that amount on your balance sheet.